Well, just if you go on Wall Street Oasis, if you haven't heard of it, just don't go on the forums. They just annoy me. Oh, I earn like $800,000. Then someone else will be like, "You're a liar. I work at this bank." And it's just like it's basically
just lying for no reason.
Oh, it's just like an extension of Twitter, but for bankers. So it's just
a great team will make a bad idea work, and like a bad team will make a great idea not work.
Blind faith, right, in the founder.
Well, I wouldn't say blind faith, but there's
foggy faith.
I shadowed a few people. I listened in to a lot of people, listening on meetings.
Sounds like a full career to me.
Yeah. I think that's the only way you can really like sharpen your investment knowledge is kind of seeing the bad companies and seeing the good companies. So
for investors that want to move up the value chain, right? What's your advice there?
Ladies and gentlemen, welcome back to episode 15 of the Mergers podcast. It's me, your host, Rory, and with me as ever, we have the schmoozer of... with me, as ever, we have the schmoozer of SaaS stock. He's the American All-Star, the Bald Beauty. Ken, how are you doing?
Doing all right. It's been a long month, but we're alive.
That could not have been a lower energy answer to me being like...
I mean, dude, after New York, Dublin, finishing the fellowship, London Business School, it's been a long month.
Should I fucking drop any more names? Just
I got more if you want.
Oh, yeah.
But there's only one that matters tonight.
Me?
Oh, you wish.
Oh. Go on, introduce our guest.
I got a good friend of mine. We met on my first day of VC, definitely. But was it your first day as well?
No. So it was actually, I think, like third or fourth. I actually spent my first day at SaaStock, which is, funnily enough, like full circle moment, you know?
Full circle. We just had it last week. But here we have tonight, Karan, who is with, formerly Mountside, now with Valiance, Series B investor, if I'm not mistaken.
That is very true, yeah.
Wow, so true.
So proud of you for nailing that, sticking the landing.
You.
Do you want to start with an introduction of what your current role is, and then we can get into what you've sort of done to get to where you are today?
Sure. So I actually joined a month ago. So I joined Valiance, which is a Series B, Series C kind of investor at the moment. They've had a few different vintages, a few different funds, basically focused on kind of just trying to change the world, have a bit of an impact, and I think that's the main thing. And I've kind of come in to kind of bring some of my knowledge from across different industries to bring a bit of a software focus and looking at lots of different industries and building out a new fund as well.
And when you say Series B, Series C, I'm assuming that's more on the sort of, well, I'd say venture side, but that's bleeding into like growth private equity, right?
Yeah, I agree. I think that's kind of where historically they've been. And I think that's where they have made most of their investments in the past, but they've also made some investments at earlier stages because they look at an SPV model, and because of that, they can be a little bit more opportunistic.
Do you both want to sort of tackle maybe what we mean when we just say bleeding from venture, which is a bit more perhaps speculative, to private equity, which is more, I'd say, financial engineering almost? No?
Well, maybe, but like I'll start early stage and then we can move on up the value chain up to you.
I'd say PE is just,
because the thing is, it's not really
PE.
PE.
Okay.
That's the thing. It's not really PE. I think it's still quite.
It's like more investment banking, I guess, huh?
It's still, yeah. PE is, and it's also late stage distress situations, things like that. Okay. Whereas this is still like optimistic. I think that's the best way to put it. I don't know how else to put it. I think as you get later and later, it becomes more and more pessimistic. That's kind of how I've always viewed it.
Where 2x is a best case scenario, I guess. Yeah.
You know,
but it's not a bad thing. I think the private equity model is probably the best model, right?
I mean, the IRR is not bad.
Yeah.
So.
I think the PE thing, there's obviously potentially less downside. Obviously, you know, if you raise a fund and buy a load of companies in the middle of 2021, you're not doing great, but it's more secure because you can, like I say, it's got an engineering element of you can actually sort of like do things with sort of known outcomes to create value. Whereas the VC spectrum, you know, seed, Series A, is inevitably you're more at the whim of the actual founder delivering on growth.
Yeah, I mean, that's why I do jokes joke. I don't even know it's a joke. Like it could come off as like vibes based investing to a certain degree. Because like the most important thing is like it is the founder. I was speaking to a guy who's looking to break into VC today, and like he's like, oh, what do you find more important, like team, product, or market? I'm like, well, none of this matters if you don't have the right team, right? And I mean, like, sure, like how much time do you and can you spend with a founder to make sure that they'll be, the one that's be able to execute. Of course, there's a track record there, and it doesn't always mean that they've had a company and exit before, but you can see from their previous roles, were they promoted quickly? Did they have ownership over something? Did they execute on that? Did they build a team out there, and how that team perform? There's stuff that you can, signals you can take into that, but from pre-seed, I mean, that's very much that vibes base, I guess. There's no real, the company's a year old if you're lucky.
Blind faith, right, in the founder.
Well, I wouldn't say blind faith, but there's
faith.
There's like half a blindfold on maybe, but then you kind of just look for that, and then seed, you kind of see things like coming to life a bit.
Market fit.
Well,
getting towards that.
Getting towards that for sure,
Yeah.
right? And then that's like, and I guess the North Star is like 6 figures, like low 6 figures ARR, right? And that's kind of that North Star that people go to, and that hopefully everything else looks good behind that. And then,
like 200-300 grand a year revenue.
Yeah, roughly. But I mean, there's companies 100K will, with a strong team, will get that seed done. And then you look on to Series A. That's when you start getting into his side, and that's where it's kind of split between us. Where like there's still like a lot of look on the founder, but like there's enough data where you can kind of like see where it's going, have projections and stuff, and then you take a look at the market a bit more and see, okay, like is this a new market being created? Is there enough space for this thing to go? Is this from portfolio construction standpoint? Is this an IPO situation, or do we want to see this as a trade sale? And if so, what kind of valuation do we target? But even then, that's still kind of maybe the engineering or like the crystal ball aspect of it. But once you get to Series B plus, I mean, it's very much like these are the models, this is the data, this is either possible or not, if I'm not mistaken.
Yeah, no, I agree. I think it really depends on the industry. I think software, there is definitely like a route, which we've all kind of been very aware of moving forward. And I think it's just hitting those revenue metrics and then the team kind of growing and kind of making the right decisions with regards to hiring. And I think that's always one of the hardest things moving forward. And I agree with the team aspect. And I think that still resonates with me throughout the whole process. I think even on later stage deals, like you'll see CEOs having to move on because the board is trying to get people away. And I think these are things you have to think about. And I think there was one thing that was it stuck with me when I was very early in my career, when I was just looking into VC. And it's like a great team will make a bad idea work. And like a bad team will make a great idea not work. And I think that's kind of something that always stuck with me. And I think just really finding the qualitative data points to really understand what's going to make a founder work for this company, the background, can they sell? Because in the initial stages, it's all sales, man,
Yeah, very much that A team, B product, B team, A product type deal where what would you invest in a binary outcome?
So you just remind me of a similar saying in sort of sales, right? Like a good sales team can sell a bad product and vice versa. And I think that's effectively what you're...
Because it is, like the CEOs in the very beginning of their careers, like that's sales. Like end of the day, you're trying to get people on board. They're the customer success team, they're the salesperson, they're the customer support. They're getting everything over the line. And I think if you meet them way more than I do, but every pre-seed founder, it's like there's hardly a team. These guys are the ones who are getting things over the line, and these are the people that are making things happen. And if you don't believe in them, it doesn't matter how good the company is. It's not going to do well.
And I guess following that journey to Valiance, right? I mean, let's say, in undergrad, after undergrad, like what was that route to get to this point?
So my background is very, very weird. I've kind of bounced around a lot of different things. Obviously, the classic finance route. I did university at the University of Glasgow, studied economics and management.
Classic.
Another classic degree.
Economics.
But I did it at Glasgow, so maybe less classic. Not really a target university. But while I was there, I started making music, and I think that was kind of my entrepreneurial kind of side, and it ended up working very well in my favor because I failed like many other people in that space and many startup founders, and I kind of like flipped it. And whenever I was doing my VC interviews, it was always, oh, look, I'm an entrepreneur. I made mistakes, I made some money, I paid my rent, and that was pretty much it. And I think that was very defining in regards to building something and kind of trying to do something that you didn't really know what you were doing and just working it out. And I think that's something that really resonated with me moving forward in my career. As I mentioned, it didn't work out, as I wouldn't be here in a quarter zip right now. But I then ended up joining a startup while I was at university in my final 6 months. They were fundraising. It was actually based in the blockchain space, which, if you know 2016, 2017, it was a very interesting time because it was just before that big boom when it hit 20K the first time. And that was super interesting, and it got me really excited meeting the VCs. There was 3 people in the team, the founder, me, and someone else working in Germany. So we were basically doing remote work before it was cool. It was a lot of fun, and I was able to meet a lot of people, kind of get really entrenched, meet some thought leaders very early in the crypto space, and that's something which really, really resonated with me again. But one of the pieces of advice I got from a lot of the people there was, do this now, get some more hard skills, and then come back. VC's not for very early parts of your career, I believe. I think it's something where you want to have skills, you want to be able to add value. And I think that's something that's really important moving forward.
Yeah, that's what I told that guy I was speaking to earlier today. He's like, I did one internship in a startup at 4 months, basically chief of staff, right? And then he was like, oh, I'm thinking about going for my master's. I'm like, you have 2 roads here. You could either spend the money in a year on your master's, or you just go for the startup route, right? I mean, if you pick right, if you think about joining a startup the same way you think about investing in a company,
it's a skill set in itself. Again, it's the assessing of a business, and a lot of this data is around, and you can see who's invested. Crunchbase is mostly free. As we're all aware, it's mostly free. There's a lot of things that you can find and a lot of things you can look at to really start to assess businesses. And I think that's kind of how you get started, right? You kind of just read into them, work out what makes sense, and look at the revenue, look at the investors, and you kind of go from there.
Yeah, it's also probably a less risky time to join a startup because we're sort of coming out that sort of year-long sort of technical recession we had where growth was 0.1%, so right on the edge. So you would expect things to get better from here, which should also then mean the small companies do better.
If they could do it now on an uplift, they should be flying. But I guess so they told you to come back, right? You did the time and they told you to come back. And what else could you obviously did the time at KPMG, Barclays?
Yeah, so I think Barclays was very much a thing where I thought that's what I was supposed to do.
Another eagler.
Is that what you guys call yourselves?
No, I don't think I was there. I don't think I was there long enough to find out that out. I was there for only a year.
You didn't get your wings.
Yeah.
He was like one of those eggs on Twitter, when they're first.
Pretty much. I don't think I knew enough people. I think I was working 5 days a week, as you can imagine. This is pre-COVID, pre all of the craziness. I think I did a few different things. I shadowed a few people. I listened in to a lot of people, listened in on meetings.
Sounds like a full career to me.
Yeah. I wasn't really doing too much there. And I think joining Barclays was really something which was eye-opening. I think, as we're all aware, the money's always good in banks, but I think I wasn't really connected to the role. I think I learned a lot and I met a lot of really cool people, but I decided to move to KPMG and do the graduate scheme there and just kind of get more of a broader understanding of industry. I did this thing called the intensive scheme where you do 14 of the 15 ACA exams in 1 year.
Jesus.
All in college. You don't do any work. So that was really fun.
Oh, you don't do any work, eh?
No, you just study. You just do exam after exam after exam after exam. But it actually was really fun. You get to meet a lot of people. And then funnily enough, May 2020, halfway through my exams, and then COVID hit. And then the next 2 years were pretty much in my room. And I think that's where I started to really think about VC as a viable career path. I was able to spend time after work when not commuting to understand more about VC. And then also while I was at KPMG, I was very lucky to move across to lots of different teams, worked in due diligence, did a little bit of audit, which is very fun. Did a bit of infrastructure advisory, but focused on sports, which was another thing. it was just interesting. And I think that's something about me. It's like, I find it interesting, I'm going to do it. And I think I was very lucky where I was able to like see lots of different things, a lot of ESG stuff as well when that was very early as well. But it was a lot of fun.
Can I just ask on the exam front?
Yeah.
What was that like, sort of explaining that you'd done it in a year and interviewing? Because obviously part of going through the grinder at PwC or wherever is that you have like 3 years and you gain experience at the same time.
Yeah.
So did you get pushback because you'd done it all at once?
No. So they did this. This basically was approved by the ICAW, right? And the idea is that you do 14 of the 15 and you do the 15th exam after year 3. So you do all the exams in 1 year and then you spend 2 years only working, and you have to do that to then get like the experience, because it's not just exams, it's also like the work experience.
Okay.
But the beauty of that is that when you're then working, you're able to kind of really get embedded into your team and work with lots of different people very easily. Whereas over the empowered, which is when you do it at the same time, you're like jumping in a team, leaving, going into doing exams, jumping back into another team. And like, it's very much, you're like all over the place. Some people swear by that way. Some people swear by our way. I preferred my way because I'm one of those people who don't really enjoy studying. So I think I need to be kind of forced into that situation. And I think in college, you're like all in it together. And I think that's kind of why I really enjoy it. It felt like an extension of university, more like a master's more than anything.
Okay.
Yeah.
So a few parties.
It was fun.
Yeah.
I guess is it kind of step on it. You mentioned, you know, you had those 2 years during COVID to kind of look into the VC space. I'm always interested in the why someone even pursues VC. I've seen a lot of VCs, like, you know, there's some programs for like young kids to learn about VC, and they have books for kids. It's like no one in there, like I believe 16-year-olds should be knowing about VC. Like this is not, you know, people want to get into it, but I don't think it's like
It's all for that sweet carry.
Yeah, because it ain't for the money up front, tell you that. But you know, how did you come about VC? Obviously, you worked for helping their fundraise as well for the company you're working at. But how did you come about VC, and how do you like? What was that thought process like? To be like, oh, this might be something for me. So
it's probably going way back now, but like me and my dad were very into technology, and we used to just love Dragon's Den, and that was pretty much it. Like, I'll be honest with you, like, I don't know if it's cliche to say that. I don't know if maybe
I've
other people say.
I've actually never heard that.
But I used to love Dragon's Den, and I just used to watch it all the time. And like, obviously, these are all B2C businesses. They're very different to like VC, but like just the idea of pitching and listening to the pitch and then deciding, are they going to invest? Are they not going to invest? Why didn't they invest? And these are the kind of thought processes like me and my dad used to have when we were like younger. And that was like my first foray. And I think when it came to like working with startups, it was like super just interesting. Like I think every time it's like everybody thinks they're about to change the world, and it's like being super optimistic. And I think I'm quite a smiley and optimistic person, and I think it just aligned with kind of what I wanted to do long term. And then like you said with the startup, like just helping with the fundraise, meeting the VCs, they walk in the room, there's like a little bit of an aura, you know what I mean? Like there's a little bit of aura coming in, and like there was 3 of us in the team, and like we're like just trying to explain to them and pitching them and like making the deck, and like they just come in and go yes or no, and it was very interesting, and it reminded me of like that Dragon's Den kind of.
So I guess with that, well, did they complete the fundraise?
I left before they did, but they did an ICO, so they started making tokens and stuff like that rather than doing the VC route.
What's your opinion on that? ICO versus traditional fundraise?
Well, look, if it's working, it's working. If they're able to raise money, I think you can't really complain. And I think it's the same with like crowdfunding. It's the same with any sort of raise. And I think if the idea is right, and I think, remember at that time, blockchain was very early, it was when it hit 20K when everyone got super excited again, but they were doing it just before then. So it was like, and I guess that's another thing. It's like VC, you're supposed to, in my opinion, invest in things that people don't think is going to be something.
The contrarian view.
Yeah. And
versus the party rounds.
And I think that's what I believe VC was. As you get into it, it becomes less like that. And maybe that's because of just how things have changed over time. But I was always under the impression that you're supposed to invest in places where other people aren't, get the right valuation, see something that no one else sees, like the contrarian view, like you said, and go from there.
Yeah. So you basically, where kids are watching like dinosaurs and space videos, like, I want to be an investor. So you are that kid that grew up to be, wow.
Well, I wanted to be a rapper first, but then I saw Jay-Z was investing, Nas was investing in Coinbase. and it kind of aligned, you know?
So you want to get on their level. Fair enough.
On a similar note, I'll tell you that is also my story. Apparently, when everyone was like, I want to be a astronaut, I'd be like, I want to be a stockbroker. And my dad would be like, I don't know.
It's not the 80s anymore.
Yeah, he'd be like, it's just, I don't know if this guy's the ticket. And I'm certainly not. But he did say to me a few years ago, he's like, I'm sort of glad you went into finance because I did think about letting you run free on the farm, if you know what I mean. And I was like, oh, wow.
Damn, so a couple of exciting kids here, it seems like just...
Oh, I had the music thing. I went that route. I think you got to take that. I tried it, and Jay-Z was like the investor. He was like talking on all these songs, 1 million, 2 million, 3 million, 4. That's the bit that resonated, you know?
Fair enough, and I got you here.
It's not even a flex nowadays, post-inflation.
And what did it look like in the process of getting into VC? Obviously, people do a lot of crazy, strange things to get into venture. But like, what was that? One, identifying the firm, going through the interview processes.
So I interviewed for a lot of VC funds. Most of them were like in the middle of while I was at KPMG. I think I kind of decided very quickly that I didn't want to do any accounting roles. I think I liked the idea of what I was learning and things like that, but I kind of wanted to transition very quickly. A lot of the advice I had gotten from a lot of people is like, the longer you stay at KPMG, the harder it gets to leave. And I think it's very hard to move out. Like the auditors, for example, who then end up in investment banking, they're going the moment they qualify, you know? And I think I was very much like, okay, I'm going to start researching. I spoke to a lot of my friends, like Kat, I don't know if you remember her. I don't think you ever met her, but she started a company. She used to work within the VC space as well. And I was very aware of the US market rather than European market. So she put me on the John Gannon blog. I don't know if you remember that. But that was something...
I've never even heard of this.
But this is the thing. This was like early doors, and it was like very much like job postings in the US and like thought pieces, things like that. And I just started reading. And I was like, there must be one for Europe. And then I found another one called Innovators Room, which is like a Slack group. And there was another one, Gen Z VCs. And these all kind of came up during that COVID period, and they were posting jobs, they were posting thought pieces, people talking about why they want to get into VC and things like that. And you kind of pull from all these different sources. And they had like a job posting, which was posting jobs on the day. I was applying on the day, getting through interviews. Funnily enough, I was telling Ken before as well, like I ended up applying for some of the top tier funds. And I didn't know they were top tier at the time. I think I was just applying because like there's not many VC roles. I'd say there's like one every like 3-4 weeks at that point. So if it comes up, I see it, I answer the questions. There was no chat GPT. I actually had to think about what I wanted to invest in and give like an opinion. And my opinions were very much based on, I think I had a bit of experience on blockchain, and I think it was a little bit hot right then. So I was like, okay, there's this company in the blockchain space. This is why I'd invest in it. Why would I not invest in this company, et cetera, et cetera. And I would be getting quite far down these interview processes, never getting the job. I think there was always an investment banker in the final round or a management consultant or something like that who's kind of taking a pay cut to like getting to venture. But it was that process where you get very entrenched. I met every single person I would meet by the end of the round. You just go, okay, let me get you on LinkedIn and say, oh, is there any advice, anybody I should speak to, things like that. And just kind of trying to like really expand my network, because most of the things I learned from other people was it's all network. And I think the network was starting to grow and still failing at every single hurdle. But
failing upwards.
Yeah, but every single partner who I ended up meeting or any principal was like, Karan, like, you have a very, very weird background, and we like that. And I think that's something that kind of made me wanted to keep going. And it was never like, oh, maybe you should rethink this. It was very much like, you know your stuff. There's other people who maybe have like invested in startups or been a previous founder or anything like that. I didn't really have that. So it was very much, how do I like portray that? And that's kind of where the music side, and I was like trying to think, okay, I was entrepreneurial. I was doing something which is a bit contrarian, trying to do something which everybody else would maybe laugh at or say, oh, why are you doing that? But you did it, and I made some money. And as soon as I made money, everybody wants to go, oh, how can I get some tickets? Or you know what I mean? Like that's kind of how it was, and that's kind of how the process worked for me. And then ended up leading me to Mountside, which kind of was a very nice fit. Lots of accountants at that firm who kind of came out of PwC. They knew what I knew. They knew what I didn't know, which was really important for me.
Well, I guess for like the guests, if you could explain, because obviously we went into Valiance, so it's a bit, if you could just preface that with what Mountside does as well.
Yeah, so Mountside is basically an advisory firm, but the idea is that they help startups to raise from VCs. So that's like financial modeling, things like that, pitch decks, investor outreach, things like that. They also help VCs to raise from LPs, and then they also have an accelerator. And the beauty of that is that you're kind of across the whole market. And I got a lot of exposure very quickly. I met this guy. I went to events. I went to SaaStock. I went to Slush. And you just meet lots and lots of different people. You're getting operational experience by doing all of the strategy and the financial modeling for these companies raising Series A. You're networking with VCs, and you're also meeting LPs. So you're like very, very aware of the whole market. And I think that's kind of why I really enjoyed it. And like, I don't have a bad thing to say about them.
You mentioned KPMG, right? Because that also probably ties into when you in those last stage rounds where there was someone taking a pay cut, right? But you'd mentioned if you didn't leave early at KPMG or probably a firm similar to that, you weren't getting out. Why is that? Is it because people got comfortable, or was there a barrier there, or something like that? What was the reason for that? Because the reason I ask is because we do have folks that kind of go into startup route or tech, or like, you know, we could argue VC is kind of a bit ropey. It's not as secure, right? But what's that look like?
I think what it was is like, I think the longer I stayed at KPMG, the harder it would be to take a pay cut. And I think that's kind of what it was. I think leaving KPMG, I think when I qualified, you're on like 55K or something like that. And it's a great salary. And I think with venture, I think I was very aware that I might have to come in at analyst level or associate level, probably at tops, associate maybe. And I think I knew what the salary bands were like. And I knew that as I get deeper into KPMG, every year you're getting a pay rise. Like it's just kind of how it works. And you get more and more knowledge of being an accountant and an accountant within deals. So you work on deals which are very accounting heavy. And I was very aware that it's not really a skill set you really need at early stage VC. I mean, maybe later stage, and I didn't really know that at that time. And I think I'd met a lot of people who had broken out. And like I would speak to any accountant I could find who was in venture capital. And I'd look at their LinkedIn and I'd be like, okay, they did a year and then they left. Or they did 2-3 months and then they left. And then everyone else is either they stayed very long and then just became a partner at a fund, or they did the CFO route, became a CFO at a startup, and then went into VC. And I think I was looking at my age mates and people who had done it before me, and trying to like kind of imitate in a way, but then also kind of create my own path.
I think there's also like a safety element.
Yeah.
And I remember being at uni and thinking some of these institutions, whether it be a top 4 accountancy firm or like a big bank, you think they're like the most cutthroat, but actually they end up being very big corporates, and it's safer than going to a 30 or 50 man firm where you like there is nowhere to hide. So that's I'd imagine that also like factored in
100%. And I think that's like literally like I think I met so many people at these firms, and like you could kind of coast, man. You didn't really need to do anything, and it's very hard to get fired at these companies. And it's not to take away from KPMG or anything like that. Like it works, like the model works, and it's been working for years and years and years and years and years. They get these grads, they're cheap labor at that sense, and they're doing the work and they get things done. And I think end of the day, if it's working, it's working. And I think I agree with you. Like I kind of wanted to be seen. I kind of wanted to like have more of an impact and kind of be on me, held a bit more accountable, kind of the work I was doing. And I wanted to do something I was like researching for fun in my free time. And I think that's kind of what it really was.
Out of interest in the interview process, how easy was it to display like a genuine passion for VC as opposed to, I've just, Googled something on the weekend?
So I think it came from failing in every interview initially. And I think it's like slowly you just kind of build out an idea, and then you kind of also start to understand the kind of questions you get asked. They're not always the same, but it's like I would have like basically a cheat sheet for every single firm that I would apply for, and I'd have basically pretty much every kind of question. Some of the interesting ones I got was like, oh, out of our fund, who would you have not invested in? And I'd like to like bring that up and like talk about those things as well. And like, why would you have invested in these companies? And then also thinking about having an opinion, whether it's right or wrong, but having it backed up by like numbers, backed up by, I guess, where investor appetite is going, and kind of just trying to think about things outside of, okay, I've just read this in a newsletter. And it's more like, why do you think that? Because all of the interviews I had, it was very much intellectual curiosity, right? Like you just want to prove that you're curious, and you'd go deeper to understand that. And I think that's kind of why there's a lot of strategy consultants in the industry, because they have to do that all the time for a case study. You know what I mean? And I think it's just bringing it all together. I don't know if I answered your question, but that's kind of how I used to go about it. It's just the cheat sheet, having answers and going from there.
But do you think having like a genuine interest, do you think that came across and that helped?
Yeah, I think, and it's a storytelling aspect, right? And I think venture capital, startups, it's all telling a story, because you're trying to sell the optimism, you're trying to sell yourself. And I think if you can't do that, it's going to be very difficult to do well in this industry, because you have to meet people, you have to like meet other funds, because most funds aren't investing by themselves. And I think you have to be aware of the market, aware of what's going on in the market. And the genuine interest did come from the fact that I was an entrepreneur. I was interested in Dragon's Den, and I was working at a startup before I guess people were even thinking about working for startups. I didn't get the summer internship, so I was like, let me do a startup. And I think that's kind of how I used to think. And I think they could see that, because there was not many people at that point who were that interested in VC coming from my background. And I think that's kind of what I wanted to come across. And I think that's why I probably got these interviews, because I had a very different background to the IB guys, the strategy consulting guys, and the ex-operator guys. And I think that was kind of what it really was.
Do you have any regrets about not going slightly more traditional? Do you think you made it harder for yourself in some sense?
I think I definitely took a lot of steps to get where I got to. It would have been nicer if it happened earlier, when I was doing those initial interviews and I just got the job. I became an analyst, I went through the process, and it just went through that way. But then again, I think some of the things I learned at KPMG with regards to understanding a financial statement, there's a lot of VCs that don't understand a financial statement. It's not to take anything away from them, because I don't think you need to at very early stages. But that has added a lot of value on the operational side, because when I was then working with Mountside, I was building financial models for these startups who were raising money from VCs. And it's like I was getting a lot of strategy understanding and why these companies are raising. Like, is it because of this number? Is it because of this number? Is it because of how they acquire customers? Is this the right metric? And really getting to the depths of what makes these companies tick. And similarly with Barclays, like relationship building wise, like I think I learned a lot there, because you're constantly talking to clients, you know this, and it's like being able to like prove yourself and bring the numbers behind it. And I think that's something I learned from there. And then similarly at Mountside, it's just bringing it all together. And then I was able to then add that value to startups, which in my opinion is the most important thing, right? It's a value add. I think these teams are very small in venture capital, and you need to be able to add value. And hopefully my value add is the fact that I do understand more on the operational side. I have kind of understood what it takes to get from Series A to B, and I can work with these companies. And I think that's what I hope comes across.
Yeah, and I guess with Mountside, the sweet spots like seed and Series A, right? How is the
and B to be fair? Yeah.
Well, there's the mindset shift where obviously going from advisory, more operational, moving into actually moving to that point where you're now allocating capital, right, or beginning to fit into that role. What has the mindset shift been like for you in terms of now allocating capital, but also usually work from Series A, seed and Series A to now just looking at Series B and above?
The mindset shift is definitely, I think you think a lot more about what's above you. I think wherever you are in a situation, right? And I think you're thinking about the LPs, you're thinking about, okay, we need to return money. And I think that's something that's really important to think about. And I think I didn't really have to think about that before. What else? And I think it's also the numbers, the kind of really understanding whether or not this founder is going to be a right fit or not. it's very difficult to like really explain, because I'm just bringing everything I've kind of learned to the table. I think the stuff that I did at KPMG was for really big companies, and I'm able to like whittle that down, mix it with kind of the stuff I did with startups, and trying to like prove that moving forward. And then also, I think with regards to investing, I'm kind of thinking about, would I actually invest in this company? And I think that's something which I'm still learning, I'm still trying to get better at, but it's definitely something that I'm excited to get better at.
Yeah, it's easy to build conviction, but enough conviction to know you'd pull the trigger in that point, right?
Exactly. And I think it's like when you're helping these companies, you want them to raise, but you're not the guy
Pulling the check, right?
exactly,
You're not writing the
like,
check. Yeah.
You know what I mean? And I think it's like that kind of comes into it, but I do think I want to maintain that optimism, and I do want to like not kind of drill down too hard and like not invest. I want to still have that conviction and build that conviction over time. And I think these things grow. Like when you first started, I don't know how you felt, but it takes time, to really build that track record.
It was a wild time for sure. I mean, like, kind of just went in, like, I knew a VC, but I was just working in startup, like, oh, fintech's a place for me, whatever. And then this came up, and I was like, okay, well, there's a lot of learning to do, and it's really just like, either you start reading books, start having the conversations. I guess at that point, I'd had the network already, because I'd been in the space and worked in partnerships, so you kind of have an idea of who's around doing what. But yeah, it was definitely a weird shift. I think a lot of times just figuring out that pulling that trigger, right? That's always the hard one. There was a guy I was speaking to last week, and he in our program, he was like, yeah, I was really railing hard in our IC. We need to invest in this company. We need to invest in this company, and like they just weren't having it. And so one of the partners was like, you know what? If you want to invest in a company, I'll give you money to invest in this company, but as a loan. And he was like, and there's no interest, free loan, but if you have to pay back at some point. And it was that moment he realized he wouldn't invest in it, because he didn't want to take the loan. he didn't have enough conviction to say this is it, which is hard,
It's not easy.
It's the one thing that I've learned from you and everyone else in the group, because we have our group chat, and then the deal flow forum where we've been sharing quite a lot of the deals recently. And when this was all first coming together, every deal that came in, I was like, this is fucking slam dunk. Like, this is amazing.
To be fair,
they're selling Russian nesting dolls made of cheese. This is gonna go crazy. And I couldn't understand why, some of them were just getting passed on.
Yeah.
And then it's like, it's only when you see those deals and over time, and you now get a feeling for like the ones that are actually gonna like get traction in the group, and the ones that like even now sometimes I just see someone, I'm like, oh, rubbish.
Wow. He has the eye.
I've gone too far the other way. I'm now it's hypercritical, but
it's good. I mean, you need
the balance, right?
yeah.
Skepticism is healthy. You need to be like, my old professor used to say, it's either you're a participant or you're a spectator, right? So it's what do you choose to be?
Got to get in the arena.
Exactly.
Skin in the game.
Skin in the game.
Skin in the game.
That's any more sayings you want to throw out there?
I've got a few.
Wow.
I'll pepper them in if I can find a way to put them in.
There we go.
So maybe one place to take this would be moving from, I would say, a very retail VC, still finding his feet in terms of how to invest and what a good startup is, to your role at Valiance. What's the sort of investment process? I know you said modeling, but like how much harder is it, to actually raise funds and get past sort of professional VCs?
From a startup point of view or a VC point of view?
Yeah, I guess the question would be, obviously, look, anyone, with some money can write a check, but what's the actual investment process that goes behind a VC fund?
Okay. So I think the main thing is kind of pipeline, right? And I think pipeline can come in many, many different ways. I think it can come from cold outreach, where you find companies which you find interesting. Warm intros. I think warm intros are probably my favorite, and I would say most people's favorite, when a fellow investor or a fellow person that you just trust sends you deal flow. And I think that's something that's really, really important. Also, just from your network of investors that you may have co-invested with before. I think that's really, really important. And then more than cold outreach is like going out into the wilderness, going into the conferences, trying to meet as many companies you possibly can. And I think that's the only way you can really like sharpen your investment knowledge, is kind of seeing the bad companies and seeing the good companies. So taking as many calls as you can, meeting as many companies as you can, and really trying to like build out a thesis as to why you are or why you aren't investing in a company. Yeah. Post that, I would say, after the pipeline, once you've found like a pretty decent deal, it's that DD, and that can take very long or very short, depending on how well they answer the questions. Normally, I would say 2 to 3 rounds of like asking them questions, getting some data, understanding as much as you can. Post that, probably thinking about exits, thinking about financial modeling, and thinking about a way to create a memo which you can then pitch to your IC, right? And I think that's super important.
IC being investment committee.
Yeah. There we go. So basically, in most funds, they're very small. But the idea is that this investment goes through the ranks, so analyst, associate, principal, and it hits a point where we now need to pitch it to everyone. And these are some of my favorite meetings, like ever, because it's the one time where you're kind of bringing it all on the table. You've done weeks of work, you're bringing everything together, and everybody's going to go into it. Everyone's done the research, everyone understands what's happening, and you have to sell that to your team, basically. And most VCs, and I'd say the way that we work as well, is you want everyone on board. You don't want one person not on board. And I think when the team's small, you need to all believe in it, and getting that conviction from your whole team is really, really important. And it tends to be when the partner gets more involved in kind of understanding the investment as well.
Yeah, and I think that's like, on that note, shout out to Michael Tafula on this one. He did a nice piece on, investment committees and how do you get those outcomes. And like you mentioned, consensus is a big one. And depending on how they structure themselves, it could just be like, some funds have a champion one where like there's just one person just really going for it and they don't need everyone. It could be some that do majority or supermajority. And then there's also ones where if you just select number of partners, they could do like a joker card type scenario. And all that means is basically, we all have a set amount of jokers in this fund, like not the firm, but the fund, like a fund 1 or 2 or 3, whatever it may be. And, I have such high conviction on this. I'm willing to put this card on the line for that. Like, it doesn't matter what anyone else thinks in the IC. We're doing this. So there's a lot of different ways you can do an IC.
Okay, so that's quite interesting. So you got these joker cards, but how are you then judged as a VC? Are you judged on deal flow? Are you judged on how many you commit to? Are you judged on, your track record? Because obviously that's only knowable later down the line. So like what makes you good at your job?
I think one of the things I was told very early was you don't actually know if you're a good VC for about 7 years, 10 years. I think the idea is just
wild.
It's just, that's the thing. And it's like, it's kind of being really on top on what's happening in the market and trying to find those outsized returns. I think one way to track things is probably, are they raising another round?
Yeah.
How easy is it for them to raise another round? Are all the investors who invested at A following on? Like these are the kind of the small metrics that you can probably track. I think some funds, they have 6 investments a year, some do hundreds, and it just depends on kind of the stage and kind of where you are. So I think the ones where they're doing way more investments, I'd imagine it's more about kind of what companies you bring to the table, whereas a bit later stage, it's like maybe 5 investments a year, something like that. You just want to really just see, are they raising again? Are they hitting the metrics that they spoke about? And I think that's pretty much it, really. I think, and then obviously exits, but unfortunately, it's a long, long road to get an exit unless you get very lucky.
So I guess in terms of how you assess an investor, right, it's like a life cycle thing. So if you talk about those first 7 years, at least initially, deal flow is definitely how you can assess. So say maybe first 1, 2, maybe 3 years, and then like in between that exit period in that year 7 and before that 3rd year, you're looking at markups, right? Mm-hmm. How many of those deals have you done that have really achieved it? But there's also the part as well, and then obviously deals. Hopefully you're getting good deals on trade sale or IPO, but it's also, and from a deal flow perspective, and really selection, it's like it's worse to miss that home run than to invest in a company that does 10x, but you had the opportunity to invest in 100x, but you didn't, right? So those are also things to take consideration as well. It's not just winning; it's winning big. Yeah.
And this is the thing. Those that's how VC works. The model works because we get those home runs, or hopefully we get those home runs. And I think without those home runs, the VC model doesn't work. You need to get those outsized returns on maybe one or two companies, depending on how big your fund is, and you need to 5x that fund, 3x that fund, depending on kind of who you are. But you need that multiple, and you need to get that return. And I think you are investing in companies that you hope will become billion-dollar companies, and that's pretty much it.
Yeah, the financial mechanics could be pretty nuts because, like, you have all these large funds. How do you 2x that, right? If you talk about like 300 $500 million, like it's just like, how do you return these really? Like that's why if you look at the returns of a smaller fund, like they're usually higher because like if you hit that and you get a great multiple on the business, it's just different play.
You're in.
Is that like part of the problem with these giant Sequoia mega funds?
Some say they're addicted to management fees. I think they've just done a great job.
And that's the thing. It's like they've done how many funds now? And when people invest in them or in those companies, it's like a stamp of approval as well.
No one gets fired for buying Dell. No one gets fired for investing in Index or Sequoia.
To be fair, I've got to be honest, you also have that issue in public markets.
Well, people investing in Dell.
Well, no, like you just have that problem. Like you think about it in hiring, like your story, right? Mm-hmm. Part of the reason the investment banker gets to the final round is no one gets fired for hiring an investment banker from Oxford, right? And it's same in public markets. Like we just did an episode on crypto, right? Mm-hmm. You could think Coinbase or Bitcoin is the greatest investment in the world, but you're going to get fired if you buy it for someone and it goes wrong. So it's just incentives, right? And that's going to be no different in VC. You'll get different flavors and stuff, I'm sure, but
I think it's definitely changing.
Well, I saw a post put up by Michael Jackson, not the Michael Jackson, but a Michael Jackson.
I know him.
Yeah, he's pretty funny. So he put out some data that kind of showed active investors in the U.S. I think at the height, when things were very frothy, I think it was about 25, because it was like 2 days away, but so it was like about 25,000 active investors, at least in the States. By the end of this year, that's probably going to be around 11,000. So I guess it's the same way we were flush with capital, which means we were flush with new people. Not everyone gets into it for the right reasons. Like you said, stamp of approval a lot of times. But yeah, it is getting better. I guess the people that are doing it because they actually want to be in this space, not because it's cool to be a VC. Is not that I agree with it's cool to be a VC, but
I think it's cool looking in when you're in it. Like I think it's like every job. There's good things and there's bad things, and that's just how it is. But I think as long as you find what you're reading about every day interesting,
yeah,
you can't complain too much.
To be fair, sorry, just to circle back to what you said, I listened to a really interesting interview with, I think he's the founder of, I think it's Veridad Advisors, but it's like a hedge fund basically. It's got like 900 million AUM. I think this is the guy. His whole process is like, it's quite interesting. It just takes a very different view. And it's all about like behavior being predictably irrational. So obviously like you'll always get different irrational behaviors, right? The bubbles, panics, crashes, etc. But the one thing that is predictable is that people will chase at the top, panic sell at the bottom. They will, overpay to hedge their portfolio when they're on the 2% drawdown, they get fired at 3%. Like there's so much predictably, irrational behavior. And he did this really interesting study of, he was like, if you take all the equity research analysts at banks, which are known to have their own issues, but are still nonetheless very good and important. And he was like, if you look the companies that are the most consensus hated and short and the most consensus longs, he's like systematically every time the ones that are most hated outperform expectations and actually do okay, and your consensus longs do badly. And he's basically just built this whole process on effectively trying to find a systematic way to generate alpha from that predictably irrational behavior. And I thought it was very interesting.
I would love to see their reports.
Isn't this like what we used to study in economics? Utility? Is that the one?
I don't know if it'd say utility. He did have an interesting quote. It was like, no one doing an MBA ever discusses forecasting error, but yet we all know it's there. So it's like it's all on forecasting and models, and I'm going to do my discounted cash flow, etc. But it's like everyone creates forecasting errors. So why aren't we discussing and studying the forecasting errors so that we can then profiteer from your sort of distribution of forecasting errors?
Yeah.
I think just before we wrap up, it'd be good to touch on career advice. Obviously, VC is a very popular job. Do you have any advice for people struggling to break in, wanting to break in?
I think for me, it's something I kind of touched on before. If you're finding it difficult to kind of break in, maybe you don't have the right experience, things like that. I have met VCs from very, very varying backgrounds. And the main thing they've always said to me, and I kind of agree with it, is find your value add, right? Every VC is very different in the sense of venture capital funds. They have different people within them. I've met people who kind of went in, they came through the talent route where they were very focused on hiring, and then their kind of value add to the portfolio companies and also the VC is they were to help them with hiring, which is a significant pain point for most startups. For me, for example, financial modeling, understanding a financial statement, and then just general operational experience is something that I feel like I bring to the table. Maybe with you, I'm not too sure, but the sales side and your background in banking and things like that kind of comes together, and you're able to then add value to these companies. And I think it's not really a singular thing you can or can't do. It's very much what do you like to do and how do you think that can help startups? And I think that's kind of the best way, I would say, anybody to break in I would have, really. Yeah.
And does that, out of interest, that value add, like you say, that depends, I suppose, where you want to go? So obviously pre-seed is going to be very different to Series D.
100%. Like my skill set, I would say, is useful at the earlier stage, but probably Series A and maybe seed. I think with the valuations now, probably seed. Yeah. But in the grand scheme of things, it's like, where do you want to fit into this market? Like a pre-seed fund is very different to a Series B. An EIS fund at Series A is very different to a different type of Series A fund, which is obviously looking for more outsized returns. And I think it's just really understanding where you want to go and just understanding the different types of funds. I think it's not like in banking where there is like a investment bank here, an investment bank here, and they do kind of the same thing, but just a little bit different. All these VC funds are very, very different. And I think really taking the time to research what they do, what they invest in, and where they invest really goes a long way.
And I guess on that, for investors who are already in the space, we've seen a few of them that want to move up the value chain, right? What's your advice there?
I would say, like, the modeling side does get very important. I think understanding how to financial model and understanding a statement really starts to get more important as you go closer to private equity. And then I think it's something that can be learned. There's so many courses nowadays, and I think it just takes a bit of time. I don't think you need to be an accountant to do that. I think you can kind of just do it because you want to do it. And there's unlimited resources now. I think the internet is a beautiful place. And when I was kind of researching, I didn't have anyone to ask. I just went on the internet and went from there.
I mean, Wall Street Oasis is
fantastic.
Basically what I've used throughout the years whenever I need something.
100%.
Yeah.
All the words and like just understanding just random things. Like Wall Street Oasis has a lot of stuff. I agree. And even there's another one as well, which I can't remember the name for. But
Investopedia
is pretty good.
Investopedia.
Probably not as cool as Wall Street Oasis, but they're helpful.
Well, just if you go on Wall Street Oasis, if you haven't heard of it, just don't go on the forums. They just annoy me. So just be some jarring like third-year associate private banker being, investment banker, being like, "Oh, I earn like $800,000." Then someone else would be like, "You're a liar. I work at this bank." And it's just like it's basically
Just lying for no reason.
it's just like an extension of Twitter, but for bankers. So it's just
For wankers.
yeah, pretty much. But the courses they have there are unreal.
Yeah, and like I said, like there's so many. And there's one for SaaS, which I think I've showed you before as well. It's like called the SaaS CFO. And
Oh, yeah.
I think that's really good. And there's a lot of free stuff there, and that really helped initially. I wouldn't say everything is perfect, but it gives you a good understanding of like SaaS businesses and kind of how to think about them as well from an operational standpoint.
Where should people find you? Because I'm sure they'll reach out with questions.
LinkedIn, I would say, is probably the best place to reach out to me. Karan Chouhan. It's not how it's said. It's spelt very differently, but put it here.
That's Karan. Not
Like the currency. Like currency.
Yeah, you say it like currency. My name's Karan Chouhan, and I wish that was my rap name. I thought of it way too late.
Karan, Ken, thank you so much. Gaz, as ever.
Guys in the original pound.
The original pound. It's never going to die. Thank you very much. See you next week.
Take it easy, guys.